There are 4 different types of mortgages most folks use to buy a home. I'm going to run through them rapid fire and give you a few highlights for each loan type and anything good or bad you need to know. You ready? Here we go. Conventional mortgages, one of the most common loan types. These are the most desirable to sellers. If you're approved for a conventional loan, sellers believe you're in a better financial position and more highly qualified than folks who are approved for some of the other loan types. If you qualify for this type of mortgage, you most likely have a strong credit score and a low debt to income ratio. Another thing sellers like about conventional buyers is the appraisal process, because the appraiser is much less likely to require repairs on the appraisal than government-backed loans like FHA, VA, or USDA. FHA mortgages. These are a great option for folks with less cash, higher debt to income ratio, and lower credit scores. FHA loans are backed by the government. This allows lenders to approve buyers who maybe otherwise wouldn't be approved. On the positive side, FHA loans only require a 3.5% down payment. There are many first-time home buyer and down payment assistance programs that can be paired with them. On the negative side, the mortgage insurance premium remains in place for the life of the loan, and some sellers steer away from buyers with FHA loans when there are multiple offers because FHA appraisals are much more likely to call out repairs sellers would be required to make in order to close the sale. VA mortgages. These are exclusively for folks who have served in the military. The best part is they are a zero down loan, so no down payment needed. Also, because the mortgage is 100% guaranteed by the US government, there's no mortgage insurance on the loan, so you have a lower payment. Also, if you're eligible for VA disability benefits, it's very likely your funding fee will be waived. And fun fact, interest rates for VA loans typically run 1/4 to 1/2 point below conventional mortgage rates. On the downside, when we're in a heavy seller's market, some sellers mistakenly think VA buyers aren't as well qualified as other buyers. And they also think VA appraisers are more likely to call out repairs that sellers would have to fix if they want the loan to close. USDA mortgages. These are loans offered by the U.S. Department of Agriculture. They're also known as rural development loans. Why is the Department of Agriculture in the mortgage business, you ask? This program was created to help people become homeowners in less densely populated areas. Some good things about RD loans. They are zero down, so no down payment required. Also, the mortgage insurance premium added to your monthly payment is less than it is on other loans. And of course, with the good comes the bad. The house has to be located in an area that is eligible for RD loans. This will be areas that are lower population density. There are also income caps on the borrower with USDA loans. If the total income of all members of the household is above the cap, you can't get this type of mortgage. So there you have it, the 4 most common loan types. Of course, this was not an exhaustive list. There are many other mortgage types out there. And there's certainly much more to know about these 4 loan types than we can share with you in just a few minutes. If you're trying to get a handle on what type of financing is best for your unique situation, give us a call or send us a text on our real estate hotline and we'll help you out.